What is interest? Interest is the cost of borrowing money, or the return a lender gets for giving a loan. It compensates for time value of money 0, risk of default, inflation, opportunity cost. Different economists have proposed different theories explaining why interest exists. Classical theory of interest, also called the real theory of interest. This theory says interest is determined by demand and supply of savings. Supply of funds equals savings. Demand for funds equals investment. When savings equals investment, right pointing arrow, equilibrium interest rate. Key idea. Interest is a reward for saving and waiting. Loanable funds theory. This is an improved version of the classical theory. Here, the interest rate is determined by the demand and supply of loanable funds such as savings, bank credit, dishorting, money creation, public borrowing. Demand comes from business investment, government borrowing, consumption loans. Key idea. Interest rate adjusts until supply and demand for loanable funds match. Keynesian liquidity preference theory. Proposed by John Maynard Keynes. Keynes said interest is not a reward for saving. It is a reward for giving up liquidity. People demand money for 3 reasons. Keycap 1 transactions motive, daily needs. Keycap 2 precautionary motive, emergencies. Keycap 3 speculative motive, expecting future rate changes. Interest rate is determined by demand for money, supply of money, controlled by RBI. Key idea. Higher liquidity preference, right pointing arrow, higher interest rates. Modern theory of interest is LM model. Modern economists combine both real factors, investment and savings, monetary factors, money supply and liquidity preference. Interest rate is determined at the point where is curve, investment savings, LM curve, liquidity preference, money supply, intersect. Key idea. Interest is influenced by both real economy and money market forces. Time preference theory. According to this theory, people value present consumption more than future consumption. So interest is the reward for postponing current consumption, accepting future payment. Key idea. Interest compensates for waiting. Neoclassical theory of interest combines marginal productivity of capital, return on investment, time preference of consumers. Interest rate is where productivity of capital equals time preference of consumers. Factors affecting interest rates. Interest rates are influenced by RBI monetary policy, inflation, demand for credit, government borrowing, savings rate, liquidity in the market, foreign investment flows. Types of interest. Real interest rate equals nominal rate, inflation. Nominal interest rate equals market rate. Simple interest, compound interest, fixed versus floating interest rates. Repo, reverse repo, bank rate, etc. Conclusion. To summarize the chapter, different theories explain why interest exists and how rates are determined. Classical theory, right pointing arrow, savings and investment. Loanable funds, right pointing arrow, broader supply and demand. Keynes, right pointing arrow, liquidity preference. Modern approach, right pointing arrow, iodine monosulfide LM. Time preference, right pointing arrow, reward for waiting. Easy level. Question number 1. Interest is the reward for A. Spending money. B. Parting with liquidity. C. Holding cash. D. Consumption. Answer. B. Parting with liquidity. Question number 2. Classical theory focuses on A. Savings and investment. B. Inflation alone. C. Money supply alone. D. Government spending. Answer. A. Savings and investment. Question number 3. Keynes theory is known as A. Loanable funds theory. B. Liquidity preference theory. C. Classical theory. D. Real theory. Answer. B. Liquidity preference theory. Question number 4. Time preference theory emphasizes A. Future consumption. B. Present versus future preference. C. Government borrowing. D. Inflation. Answer. B. Present versus future preference. Question number 5. Real interest rate equals A. Nominal plus inflation. B. Nominal, inflation. C. Inflation, nominal. D. Nominal times inflation. Answer. B. Nominal, inflation. Question number 6. Loanable funds theory includes A. Only savings. B. Savings plus bank credit. C. Only investment. D. Only government loans. Answer. B. Savings plus bank credit. Question number 7. Interest exists mainly because people prefer A. Future consumption, B. Present consumption, C. Foreign goods, D. Low prices. Answer: B. Present consumption. Question number 8. Liquidity preference includes A. Trade motive, B. Speculative motive, C. Industrial motive, D. Foreign motive. Answer: B. Speculative motive. Question number 9. Higher inflation leads to A. Higher real interest, B. Lower real interest, C. No change, D. Zero interest. Answer: B. Lower real interest. Question number 10. Interest is the price of A. Capital, B. Loanable funds, C. Money, D. Risk. Answer: B. Loanable funds. Question number 11. Transaction motive relates to A. Business needs, B. Daily expenses, C. Investments, D. Future expectations. Answer: B. Daily expenses. Question number 12. Classical theory ignores A. Savings, B. Investment, C. Money supply, D. Production. Answer: C. Money supply. Question number 13. Government borrowing affects A. Demand for funds, B. Supply of funds, C. Imports, D. Exports. Answer: A. Demand for funds. Question number 14. Speculative motive deals with A. Precautionary needs, B. Cash kept for opportunities, C. Routine payments, D. Inflation data. Answer: B. Cash kept for opportunities. Question number 15. When savings increase, interest rate A. Increases, B. Decreases, C. Becomes negative, D. Remains fixed. Answer: B. Decreases. Question number 1. Loanable funds demand includes A. Only investment, B. Consumption plus investment plus gov borrowing, C. Only consumption, D. Only government demand. Answer: B. Consumption plus investment plus gov borrowing. Question number 2. True determinant in Keynes theory A. Savings, B. Money supply, C. Profits, D. Population. Answer: B. Money supply. Question number 3. Liquidity preference is highest when A. Interest rates are high, B. Interest rates are low, C. Savings are high, D. Investment is low. Answer: B. Interest rates are low. Question number 4. Inflation expectations affect A. Nominal interest rate, B. Real interest rate only, C. CRR, D. Tax rate. Answer: A. Nominal interest rate. Question number 5. Time preference theory was proposed by A. Keynes, B. Fisher, C. Wicksell, D. Adam Smith. Answer: B. Fisher. 6. Loanable funds theory is superior because it includes A. Only current deposits, B. Both real and monetary factors, C. Only money supply, D. Only government funds. Answer: B. Both real and monetary factors. Question number 7. Classical theory assumes A. Full employment, B. High unemployment, C. Zero liquidity, D. Fixed money supply. Answer: A. Full employment. Question number 8. Speculative demand for money changes due to A. Price of gold, B. Interest rate expectations, C. Food prices, D. Savings rate. Answer: B. Interest rate expectations. Question number 9. Real interest rate becomes negative when A. Inflation greater than nominal interest rate, B. Inflation less than nominal interest rate, C. Inflation equals 0, D. CRR reduces. Answer: A. Inflation greater than nominal interest rate. Question number 10. Modern theory of interest considers A. Only savings, B. Only liquidity, C. Multiple economic factors, D. Only inflation. Answer: C. Multiple economic factors. Question number 11. If RBI reduces money supply, A. Interest falls, B. Interest rises, C. Inflation rises, D. Consumption increases. Answer: B. Interest rises. Question number 12. When investment demand rises, A. Interest rate rises, B. Interest falls, C. Savings fall, D. Inflation stops. Answer: A. Interest rate rises. Question number 13. Loanable funds supply does not include A. Savings. B. Bank credit. C. Disinvestment. D. Government revenue. Answer. D. Government revenue. Question number 14. Classical theory is called A. Indeterminate. B. Real theory. C. Monetary theory. D. Final theory. Answer. B. Real theory. Question number 15. Liquidity trap refers to A. High interest. B. Very low interest where people prefer cash. C. High inflation. D. Bank failures. Answer. B. Very low interest where people prefer cash. Hard level question number 1. According to Keynes, interest is a reward for A. Savings. B. Sacrificing consumption. C. Parting with liquidity. D. Working harder. Answer. C. Parting with liquidity. Question number 2. The equilibrium interest rate, classical, is where A. Demand greater than supply. B. Savings equals investment. C. Inflation equals deflation. D. Consumption equals income. Answer. B. Savings equals investment. Question number 3. Wixell's natural rate of interest relates to A. Liquidity. B. Inflation neutral rate. C. Negative interest. D. Monetary tightening. Answer. B. Inflation neutral rate. Question number 4. Fisher equation states A. Real rate equals nominal inflation. B. Nominal equals real inflation. C. Real equals inflation plus CRR. D. Nominal equals savings times wages. Answer. A. Real rate equals nominal inflation. Question number 5. Keynes criticized classical theory because it ignored A. Investment. B. Money supply and liquidity. C. Government demand. D. Profit motive. Answer. B. Money supply and liquidity. Question number 6. In liquidity trap, monetary policy becomes A. Highly effective. B. Ineffective. C. Inflationary. D. Deflationary. Answer. B. Ineffective. Question number 7. Loanable funds theory says interest depends on A. Only inflation. B. Savings, credit, disinvestment. C. Only consumption. D. Only gold reserves. Answer. B. Savings, credit, disinvestment. Question number 8. Present value concept is linked to A. Time preference theory. B. Liquidity preference theory. C. Loanable funds theory. D. Modern portfolio theory. Answer. A. Time preference theory. Question number 9. If money supply increases rapidly, A. Interest rises. B. Interest falls. C. Liquidity falls. D. Investment collapses. Answer. B. Interest falls. Question number 10. Rational expectations theory affects A. Long-term interest rates. B. Only short-term rates. C. Only savings. D. Only government borrowing. Answer. A. Long-term interest rates. Question number 11. When disshorting increases, loanable funds supply A. Falls. B. Rises. C. Becomes zero. D. Is unaffected. Answer. B. Rises. 1. Question number 2. Classical theory works best when A. Economy is at full employment. B. High unemployment. C. Inflation is zero. D. Money is digital. Answer. A. Economy is at full employment. Question number 3. High-risk borrowers must pay A. Lower interest. B. Higher interest. C. Zero interest. D. Subsidized interest. Answer. B. Higher interest. Question number 14. In Keynes theory, speculative demand curve is A. Upward sloping. B. Downward sloping. C. Vertical. D. Constant. Answer. B. Downward sloping. Question number 15. When investment is interest inelastic, A. Rate changes will not affect investment. B. Rate change increases consumption. C. Interest increases investment. D. Savings fall sharply. Answer. A. Rate changes will not affect investment.